Hey everyone, Eric here. In this video, I'm going to teach you how to build a financial model from A to Z for a social network startup with advertising-based monetization. We'll model out the first 4 years of growth, including venture capital fundraising rounds with lots of discussions around businesses in the space and important things that I see happening. Okay, so let's get started with a quick overview of the sector. So social network business model. So what makes a business a social network? Two things. First thing is that it's community-based. Remember, there's a lot of advertising businesses that don't have a community, like Google search, showing a lot of ads, but nobody actually interacts with each other. And then the second thing is something called network effects. With any network-based business, a network effect is something where when one new user joins the platform, it increases the value of the product for all previous users. And it helps technology companies grow really quick. So with a social network, one new user is going to connect to a bunch of people. They're going to create a bunch of free new content for the platform. And so that makes the platform better for all the previous users. Another network, which isn't a social network, but like a financial network like Bitcoin, one new user actually has to pay slightly more for Bitcoin, bid up the price, and that increases the value of Bitcoin for all previous Bitcoin holders. So that's a network effect where each new user increases the value of the product for all previous users. So something really interesting that and very unique to technology companies. So now I'm going to just talk about a couple of the axes of these businesses, sort of they either go more towards one side or more towards the other. So the first point I want to make is that I think there's really a last generation of social network businesses, and there's really a next generation. And right now you can see really clearly sort of what's behind us and what's in front of us. And I think what's in front of us is that creators are going to make the majority of the revenue, and the platforms are going to be more like SaaS businesses where they just sort of provide the platform as a service, rather than the current version, which is like authoritarian regimes where the creators have no power and the platforms control everything and make all the money. I think that's unsustainable. The revenue split, so the last generation of companies, the platforms took 100% of the revenue, paid creators nothing. I think that's going to flip. Creators are going to make a lot more money with the new sort of next generation of social network companies. And that's going to drive an evolution from really low value, click optimized content where the platform has all the power and takes all the revenue to the opposite, which is going to be, I think, a positive thing for users, also for creators. Monetization. With these businesses, you can monetize them with ads, you can monetize them with the subscriptions, with product sales, with sponsorships, which are sort of like ads as well. So these businesses are all monetizing themselves in one way or another, usually with one of those things. And then communities. Communities is one of the really unique things about social networks, but also one of the nightmares about them. So how do they form? Where do they gather? Certain communities are just people who know each other in their personal lives, interacting with each other. And then certain communities organize themselves around a certain type of content, certain subject, a certain influencer. So they might log on and interact with people who they don't know in their personal life, but that they have something in common with. So communities can be sort of closed off, like in a bunch of different subreddits, or it can just be sort of wide open, like Facebook. And then managing the communities is hard. Some communities, like on Reddit, will self-manage, make rules, ban users if they break the rules. But then some communities the platform itself has to manage them. And so like on Facebook, when all this really crazy stuff happens on WhatsApp or on Facebook, whatever, Facebook's always responsible. It's always their fault because they're supposed to be managing their community of 2 to 3 billion users, which is like really, really crazy. So, and then the final piece is content. What's the format of the content? So many formats. You can have long, short, video, audio, text, really, really low value, really, really high value. And then the types of users that the platform attracts are massively important in terms of monetizing the platform. Some users are really valuable for advertising and some users are not. So that's important. And obviously the geographies really matter. All this stuff matters. But we're going to create in this video a social media business model with ad-based monetization that's more like the dominant last generation social media businesses. So like Facebook, Instagram, YouTube, etc. So let's jump in. So with all these business models, the first thing you need to build is sort of your user acquisition model to try to figure out your revenue and sort of how much you need to spend in marketing and then what you kind of get in revenue. And so we are going to start here in January 2023, and we're also going to assume that there's a 12-month period that precedes this where we're just building the platform, but we're not acquiring users because we don't have a product yet. So we'll model that out after. But for now, we assume the platform's going live and we're going to start spending in advertising. So let's kind of make a nice ramp. So let's say we're spending like $5K a month, and then we're getting some users, and then it's $10K a month, and then okay, it's going well, $25K a month. And again, we're going to model this out to be 4 years total, including that first sort of 12-month build. So let's see here, 50K, let's say keep doubling it, 100K through the first 6 months, and then let's just say from here we just grow the advertising 20% per month through the end of this sort of third year of user growth. So by the end we're spending what, $2.6 million a month. Okay, and so we always start a financial model with the advertising spend, and then what we need to do from there is figure out what are the customer acquisition costs and back into how many new users or how many new clients are we getting. So let's say our paid CAC and customer acquisition cost is the total marketing you spend to get one new user to basically download your product or buy your product. So I'm going to say in this situation it's app downloads, because most social networks are like completely mobile apps now. So I'm going to say we have a customer acquisition cost of $20. So it costs us $20 in marketing to get one person to download the app. So let's say for the first year it's 20, but then in the second year it's lower, it's 10. And just from then on it's $10 to get one new user to download the app. So maybe we're advertising on other platforms like YouTube, like with some cool short clip, and we're like, hey, download our whatever new app and interact with your friends. I don't know. So from that we can figure out our new users, but these are the paid users. So it's going to be 5,000 divided by your CAC. So if we spend $5,000, we should be able to get 250 app downloads at $20 a download. But what about all the people that basically are organic users who download the app because their friends told them about it, or some way that's not related to paid advertising, word of mouth, through Google, whatever it is? So this is going to be something that we model using something called the paid organic ratio. So it's going to be how many organic users do you get, or I guess the organic to paid ratio. So it's going to be how many organic users do you get for every one paid user. So let's say we start with 1. So for every one new user that we pay for, we get one user who downloads it for free, because maybe that person tells their friend. So now let's look at new users organic. So this is going to be paid times 1. So the total new users is going to be 250 plus 250. But what we're going to see over time is that we're going to get more and more organic users free as you get the network effects and as the sort of word of mouth about the platform sort of spreads. So first let's just copy this formula over. That's Control C, then Control V. Okay, so here we are. So let's say for the first 3 months, for every one paid user, you get one organic user. But then let's say, word of mouth starts getting out, and then you start getting 2 organic users for every paid user, and then 3. And of course, you need to keep spending in paid advertising because you need to keep bringing new users onto the platform. But the more popular the platform gets, the more network effects you start to get and the more sort of organic growth you start to get. So let's say sort of in the second year for the first 6 months, it's 5 organic users for every paid. And then let's say it's 10 after that. 10 after that. And then by year 3, January 25, let's say it's 20. So for every 1 paid user that you get, 20 people are going to download the app from word of mouth. And this is absolutely the kind of thing that you should be expecting, because you won't be able to pay to acquire all your users for a social media network. Okay, so then we have our sort of total new users, and this is sort of a monthly total, but we need to figure out, okay, how many total active users do we have on the platform? So first off, let's use a churn rate, users monthly. So obviously we're gonna get 500 new users, but some amount of those users is gonna drop off. They're gonna download the app, they're gonna go around on it, and they're gonna say, this thing sucks, and they're just gonna delete it off their phone. So let's say starting out, our churn rate is 10%. So each month, 10% of the users basically drop off, and especially in the beginning, because they're gonna go on there and maybe there's not gonna be that many of their friends or not that great of content. But let's say over time, as the platform grows and the network effects sort of amplify, the churn rate drops. So now only 5% of people each month are sort of churning off or canceling off the platform. So the churned users are then going to be, well, you're not going to have any churn in month 1, but it's going to be 500 times 10%. That's going to be a negative number. And so let's see here, 50. So you're going to lose 50 users every month. And so as if we copy this formula across, you'll see that each month there's some amount of users that we're turning off. So okay, so we know how many new users we're getting each month. We know how many users we're losing each month. But what about our total monthly active users? And the acronym for this is MAU, monthly active users. So total monthly active users is basically all of the people that on a monthly basis are active on the platform. So, they're logging on and they're doing different stuff. And so the monthly active users is going to be 500 plus that churn rate. So in the first month, it's 500. But in the second month, remember, it's a cumulative number. So it's going to be the previous month total plus total new users plus the negative number of the churned users. So it's going to be those 500 users from month 1 plus 500 users from month 2, but then you lost 50 users. So then it's 950. So this is a sort of our cumulative total people who are doing things on the platform. And so we're saying that we get to 30 million monthly active users by December 2025. And so first off, just really quick, if you're finding this content valuable, please like this video and subscribe to my channel right now so you don't miss any of my videos. So let's talk about monthly active users. Is 30 million reasonable? Well, definitely. Facebook right now has 2.5 billion monthly active users. Instagram, when Facebook purchased Instagram, which was widely criticized, and Facebook, a lot of people said it was Facebook's dumbest thing they've ever done. I think Instagram had about 100 million active users, and Facebook paid about $1 billion. And they built that product, Instagram, with a team of, I think it was like 10 or 11 people. So, but now Instagram has billions and billions of users. And WhatsApp, another company that Facebook acquired, when Facebook acquired them, they were getting, I think, 600,000 or 700,000 new active users every single day on WhatsApp, which is just mind-boggling. So if you get the product right and you get the network effects of the product, like sort of supernatural network effects, you can get a lot of users. So yeah, businesses do grow like this. They exist, and that's ultimately what you'd want. So now let's think about, okay, we know how many monthly active users we have. Let's figure out how much revenue we can make from them. So what we're trying to figure out is how often they log in, how long do they log in for, how many ads are we able to show them per minute or per some certain period of time, how much can we charge advertisers to come on our platform and show ads, And then ultimately, what's the amount of revenue that we can generate from this user base? So I'm going to walk through all that with all the sort of metrics that we think about when we talk about social networks and just advertising platforms in general. Because yes, it's a social network, but what a social network ultimately becomes, or at least the sort of last generation social networks, are just advertising platforms. They're more advertising platforms than social networks. So let's go through this. You have this average logins. So these are just like average sessions per month. So of a daily active user. So how many times is a monthly active user? How many times does a monthly active user log in per month? Maybe 25 times, let's say. And then let's say average session time in minutes. Okay, so they log on 25 times, and each time, how long do they log on for? Well, on Facebook, the average user logs on for, I think it's like 40 minutes a day or something around there, maybe more, which is, again, that's like really, really insane. But let's say 20, assuming that our platform, people aren't logging on quite that long. And then ad impressions per minute. So we're saying, okay, if they log on for 20 minutes, how many ads can we show them? Which is called ad impressions. And this is ultimately a concept that's called ad load. And so it's like, what's the maximum amount of ads you can show someone within, a set period of time? And so I'm going to say that we show people in every one ad for every 5 minutes. Although on Facebook, they're showing way, way more ads than that. So one ad every 5 minutes. So I'm saying ad impressions per minute is 1 divided by 5. And then finally, this will give us the ads shown per user per month. So this is kind of cool. So you take the total logins per month times the total minutes. So now you have the 25 times 20 minutes times ads per minute. So we're able to show each user 100 ads per month. So let's just copy this across. And I also want to increase the ad load over time, because these businesses, usually when you start out, you can't show a lot of ads, or you don't, because the main thing you want is for a lot of users to come on the platform, and you know that you can monetize a platform later down the road. So let's say at first we're showing one ad for every 5 minutes, but in the second year we show one ad every 3 minutes. So let's just decrease the amount of decimals here. So one ad every 3 minutes. And then in the third year, we get to December here. In the third year, let's say it's one ad for every 2 minutes. So now we've increased the ad load. And so we can show, originally we were showing 100 ads per month to each user, and now we're showing 250. So, we're probably going to be generating a lot more revenue now. Again, if you increase ad load too much, you see users start to have less activity because it gets annoying. So there's a limit to ad load, and if you cross it, you end up it backfires. So finally, there's another metric, which is the cost of advertising, and it's called CPM, cost per mil. And mil is the Latin word for 1,000. So it's cost per 1,000 ad impressions. And this is if you advertise on Facebook, Google, Reddit, Pinterest, YouTube, you'll always see this metric, the CPM, and it's, okay, how much does it cost the advertiser to show their ad 1,000 times? So let's set a CPM of like $2.50. And just by the way, this number can vary so wildly, it's just absolutely insane. It can literally be hundreds of dollars. But the average across like Facebook, Google, sort of globally is about $2 or $3. But once you start targeting more specific users, it can go up a lot. Like if you're targeting engineers with some software product, they're going to be increasing your CPM significantly because that audience is going to be more valuable for you as the advertiser. So, but we're going to use sort of a global average, which is like $2 or $3. And let's say we just that's the CPM price that we charge our advertisers, because again, we're now an advertising platform. Probably in the beginning, it's going to be 0. Let's say for the first year, we don't do any advertising. So we put it as 0 and we're going to have no advertisers because we're just trying to build up users. Because think about this, if there's only 20,000 users on the platform, no advertisers are going to want to advertise because there's not enough people. And let's say in the second year, we set a really low CPM for advertisers as our users grow, 100,000 to 1.6 million. And we're like, hey, we have a small user base, it's growing really fast. We'll give you really low CPM average, which is $1.50. Come and try out our platform. And then as we get more and more users, we can raise our CPMs. And again, this is what basically all advertising companies do. The better their ad network gets, the more they raise the price of advertising. Okay, so what do we have left? So we have revenue per ad. So how do we calculate that? In this case, we would just take our CPM and divide it by 1,000. Because remember, CPM is cost per 1,000 ads. So if we want to just figure out how much does one ad cost, we can just divide it by 1,000. And so let's see here. Yeah, there we go. So you see each ad is like a fraction of a cent. Okay, revenue per ad. And then let's have the monthly revenue per user. And we know that we show 100 ads per month to each user times the revenue per ad. So monthly revenue per user, we're pre-monetization here, so it's going to be 0. But as we move forward, you'll end up being able to monetize each user. And we see each user towards the tail end of this generates basically 63 cents a month. If you look in the United States, Facebook makes about $40 per user per year. So that would be like, $2 or $3 a month. But other advertising platforms make significantly less. And when you look globally, Facebook only makes like $5 or $10 a year per user. So these are numbers that would be reasonable. And again, I'm kind of doing this on based on a US-centric social network, but any social network, if you can prove it out in one market, then you should expand it to all markets. Then you have the annual revenue per user. So you just take monthly revenue divided by 12. So this just gives you a sense of how much is each user worth. And yeah, we're saying about $8 a year. So I think that's pretty reasonable as a gut check if you think about what other companies are doing. And then you have your total revenue, which is monthly revenue times monthly active users. So monthly revenue per user times total users. And so in this situation, over time, you ramp this up, your network effects get going. By the end of year 3, when you have 30 million monthly active users, you're getting to 18 million per month in revenue. But before that, it's ramping up slowly. So when you first monetize the platform, for instance, in January 2024, the first month you make $25,000, $26,000, and over time you're ramping this up. And as you increase your CPMs, as your organic app downloads start to accelerate, as your churn rate starts to drop, as your ad load starts to increase, your revenues just starts to spike. But with a lot of these companies, just getting all the users onto the platform is the key to being able to basically pull all those levers. So now that we have the revenue, let's move into the P&L, and we can talk about revenue, users, all the cost of goods sold. What do we do with our creators? Do we pay our creators? What about our team to build the platform, our marketing, all this different stuff? And so we can understand how much money is the business burning or losing, and how much venture capital money do we need to actually fundraise to make this work? Okay, so we actually have enough information to fill out a few things just to start with. So like I said before, our first month of our model we're saying is January 2022, and we're going to spend the first 12 months just investing in the technology and building the platform before we try to get any users. So this is going to be like this pre-launch phase. And then remember, for the first year, we're going to be getting users, but we're not going to be running any sort of advertising. And then in the third and fourth years, we're going to be monetizing the users. So year one, in our revenue section, generally, I always like to call out the most important metric of a company. And a lot of times that's how many customers, how many users, some sort of metric like that, tracking the total number of high-level customers. So we're going to have monthly active users. So I'm just going to put that at the very top of the model so that you can always sort of see that. So link it in here, go to your user acquisition and total monthly active users. And remember, January 2023. And, okay, format that, January 2023. So I'm going to hit Control C, hold down Shift, right arrow, and here we go, Control V. So now we can sort of see that anywhere we are in the model. Okay, here's where we're at in terms of users. And we also have revenue. So just go down to the user acquisition tab again and grab revenue from 2023. Remember, these first 12 months, no revenue. So just link it in. And so you can see from here that then we start monetizing the users and we can see this. So, and there's one more metric that I'd like to call out. So the you have your monthly revenue here, but you also have your annual run rate. It's called your ARR. This is very, very common. And what this is you basically take your monthly revenue, your monthly run rate, and you multiply it by 12. And so what does this tell us? So this basically gives us, so here we have 6.8 million monthly. We multiply it by 12 to say, okay, here's the run rate we're currently at. If we did this amount of revenue for 12 months in a row, it would be this much annual revenue. And businesses are a lot of times valued based on their sort of run rate. Like, okay, we'll pay 10 times revenue for your company. And so they'll look at, okay, what's your monthly revenue? You know, so your ARR is 80 million. Okay, we'll pay 10 times that, whatever it is. So it's good to call that out because it gives you a sense of sort of where you're at from an annual basis. And then let's move on to cost of goods sold. So down below I have an assumption section, and here we're gonna break out different assumptions we're making about our business. And so let's start with the creator revenue share. So like I said, most of the first generation social media companies gave no revenue to their creators. So Facebook, if you're a content creator on Facebook, Facebook pays you zero. They take 100% of the revenue. They hide all the user data from the creator. And so what's happened is that basically the quality of the content is extremely low. Everything's optimized for maximum clicks. And a lot of the actual content itself is just ads now. But on YouTube, for instance, YouTube is sort of a blend of the last generation social network businesses plus the next generation. YouTube has a very rich history of revenue sharing with its creators. So YouTube actually pays 55% of revenue. So all those ads that you see over YouTube videos, 55% of all that revenue gets paid back to the creators. And so this is the most generous deal that of any of the large social network companies right now. But now you're seeing companies come out like Patreon and other businesses that really almost all the revenue goes to the creators. And there's things like subscriptions or there's other models. So I'm building sort of a last generation style ad model plus a very generous revenue share similar to something like YouTube. So creator revenue share, 55%. Okay, and then you have, let's say, hosting, Amazon Web Services, AWS. Let's just say this is like $10,000 a month. If you don't know what AWS is, it is called Amazon Web Services. It's the largest cloud infrastructure company in the world by a long shot. It's doing more than $50 billion in terms of its ARR. And they basically took all the infrastructure, servers, all these different services, and they put it into the cloud, and then you now buy all this stuff from them through subscriptions. And it lowers the cost by usually something like around 30%, and the security is better, the speed's better. So basically all businesses are run, or kind of tech is sort of run on AWS now. So there's some competitors, Microsoft, Google, but nothing really compares to Amazon. So, okay, so let's say 10,000, 20,000, 50,000. This is a subscription we pay to host all of our tech. Okay, so those are the two main costs of sales of costs. So 55% of the revenue, we're going to collect it and then we're going to pay it back to creators. Then we have this hosting cost, but then we need to hire some team members. So let's think about this. First, we're going to need some customer support reps. Once we bring the advertisers online with our advertising platform, we're going to need customer support to help the advertisers when they have questions. So, and then the second thing we're going to need is we're going to need a huge content review team to be constantly reviewing the content and making sure that nothing crazy is happening on the platform and that they can take down any questionable content. And we're going to have rules and all that stuff. But usually you need a huge content review team. So let's start with this. Users per advertiser. And remember, advertisers are companies coming to advertise on our platform. Users per advertiser. And then with that, we can get total advertisers. Let's just fix this format. Total advertisers, and then let's say advertisers per support rep, and then customer support. So we're trying to figure out how many customer support people do we actually need. So let's say users per advertiser. So we start advertising in January 2024. Remember, 1 year of building, 1 year of getting users, and then the third year we start doing it. So let's say there's like 20,000 users for each advertiser, because an advertiser needs to be able to show ads to a lot of people. And then advertisers per support rep, maybe like 20. Maybe one rep can handle 20 advertisers. And then also let's figure this out. We want to round, let's take the total users here, monthly active users, and divide that by 20,000. That's going to get us the amount of advertisers that we can ultimately basically get onto our platform. No, that's supposed to be divided by, and then let's see. So with this amount of users, 106,000, we can get 5 advertisers. And then advertisers per support rep is 20. So then to get the amount of support, the customer support reps we need, we can just do round up. We can just say 5 divided by 20, because we know there's going to be 1 rep for every 20 advertisers. And then round that to 0 digits. So there'll be 1 rep. If there's only 5 advertisers and they can handle up to 20, there'll be 1 rep. So with this, we can just copy these formulas forward. And that's going to get us our customer support team. And then we need to figure out, okay, how many content review people we need. And again, I'm just making up these assumptions. I don't know if this is like exactly how each business would do it, but I just want to walk you through the process of how do you create reasonable assumptions that you can defend and try to project forward and create good financial models for your business. So next, let's talk about the content review team. So let's say users per content review rep. Okay, so let's say it starts out at, okay, so we don't have any users till January 2023. And let's say, one rep can monitor the activity for 50,000 users. And, probably you're using some sort of software that can flag content that is questionable, and then you have like a human review. But let's say in January 2024, you get like some big upgrade to get some more sophisticated kind of AI that allows one rep to handle even more users and sort of is able to automate flagging and taking down questionable content. Like it's able to identify it. The software is able to identify nudity or things that are dangerous for the platform or don't follow the rules. Okay, so then you have your content review team. And so that would be, okay, we get to here, users per content rep. So we're going to say round up total users divided by content reps. So for a while it's going to be 1, but then it's going to go up. So at the end of year 3, you're going to have 1,500 advertisers, 76 customer support reps to support the advertisers, and then 303 content review reps. And then also, we're going to have a benefits, taxes, etc., which is just something that we can use to just calculate the total payroll cost. So that's going to be about 25%. So usually you pay 25% on top of any salaries and bonuses that you pay to people. But 25% more is like taxes, benefits, all that stuff. Okay, so we can now build the cost of sales. So let me show you how to do this. So here we go up to the actual cost of sales. And let's create a couple sections. So first off, simple just to create the creator payments. And remember, this is the thing that most of the last gen social media companies pay 0. They take 100% of the ad revenue and they compensate nobody for doing work. But again, YouTube has sort of led the charge paying creators, and Google in general pays creators 50 to 75% of the ad revenue. So that has set a nice precedent for sort of future companies. So you're going to take the revenue and you are going to multiply by 55%. Okay, let's reformat that. Okay, so that's going to be here. You'll see that you collect 18 million, 19 million revenue when you pay back 10 million out to your creators. Okay, then you have hosting. And this is easy because we can just link it in from down below and just link it in here, 10,000. And we can just copy that number over. So copy it over, Control C, Control V. We can drag this over just for continuity. It's going to be 0. Okay, so now we have revenue, we have our annual run rate, we have creator payments, we have hosting. Now let's figure out these 2 teams that we just built. So that's going to be first customer support, and then you have content review, customer support, and then you have your benefits, taxes, etc. So here's a really simple way to model this. And if you've seen any of my other videos, I basically do this in every model because it's a really quick and efficient way to model it and very accurate. So what you do is down below you have your total, right? We calculated that in our assumptions, the total amount of people on that team. So here it's 1 and then it goes up to like 300 or whatever, right? What you do is you just put the salary to the left of the position. So let's say our customer support reps make $50,000 and they're based in the US. But let's say we decide to hire a content review team internationally. So in a different country where a lower salary is a competitive salary, where there's a lot of talent, but you can hire a team to review the content and they don't need to be based in the US. So let's say whichever country we hire that team in, you pay an annual salary of $15,000. And so that allows the company to keep its costs lower. And from there, what you can do is you take the annual salary, and I'm going to tap F4, lock the column, and then divide it by 12. So that's going to be 50,000 divided by 12. So that's going to get your monthly salary. And then multiply that by the total customer support reps, which is going to be in this cell. So now if we copy this formula down, same thing, but multiply it by the content review reps. And then finally, the benefits, taxes, etc. We're going to sum up customer support and content review, multiply that by 25%. And from there, if we just apply a little bottom border and we add this up, you'll have your total COGS personnel cost. So what we can do with this is just highlight it, shift, down arrow, down arrow, down arrow, Control C, shift, right arrow, Control V. So now you see that as the team grows, you've got your customer support salaries, you've got your content review salaries, you've got the benefits for everyone, and that the total cost of this personnel is about $900,000 a month at the end of December 2025. So from here, now you have your total cost of sales. So what you can do is you can just add all this up. You can add the creator payments, hosting, and your total personnel cost. So in the beginning, it's low. And the vast majority of your expenses in the beginning are going to be in the operating expenses, and the engineering team and the IT and all that. We're about to model that. So here you have your cost of goods sold. Then you have your gross margin. So that's revenue minus COGS. And so we can multiply that across. So you can see your gross margin. And obviously, in the beginning, it's going to be negative, but then it's going to turn positive over time. And always include like a gross margin percent, because businesses are trying to figure out, okay, what percent of their revenue can they turn into gross profit. So I like to use an if-error formula, and then just take my gross profit, divide it by revenue, and then comma, and then if you put 2 quotation marks, if there's an error, it'll just show 0. So, okay, so I have a little issue here. Okay, 40%. And so if I just multiply this back, you'll see that in any cell where there would be an error, it shows nothing because I have the 2 quotation marks. Okay, so what's next? So now we have the gross profit, and let's move on to the operating expenses. So the main expense in our operating expenses is going to be our team. So we're going to model this out similarly down here. We're going to figure out, okay, how many of each person do we need? And then we can put their salaries over here by the side and just sort of use that formula. So let's do that. So if we start here, obviously the main sort of part of our team, if we're building this huge technology platform, is going to be like technology people. So people in engineering, IT, a lot of different tech stuff. And you could create a lot of different buckets for all these different departments, but I'm just trying to create something that's simple that says, okay, we've got our tech people, we've got our creative people, marketing people, product managers, and then sort of anyone else like accounting, executives, etc. And that kind of covers it. So let's say we start out with, a big engineering team. So we start out with 20 people on the engineering team, maybe 5 creative people, 1 marketing person, because we're not live yet. So maybe that marketing person is just kind of getting everything ready. And then 5 product managers, some executives, and some maybe, 1 accountant or something like that. And then again, the same 25% here. So let's say that this team, gets us into the first 6 months. But then we're like, okay, we gotta grow this team more. We need more people. Now we're getting closer to the launch, so we need more marketing people, we need a lot more creative people, we need to double our technology team, more product managers, we hire some more executives. So now we have this much larger team, and that gets us through the second 6 months. Okay, but then starting in January, now we're going live with our users. So now it's really serious. We need a much bigger marketing team. We need more designers. We need 20 more engineers. And again, I'm completely making this up, but this is the structure of sort of how you'd want to plan out a business and think through the decisions. But it's important to always be reasonable and put in a lot of costs, because building things like this is really expensive. So let's say we have more marketers. Let's say we basically just like double almost every team now. Keep almost doubling everything. Now we have this huge team in 2024, and that takes us through the end of the year. And let's say in January 2025 that we have 100 marketers, 50 creative people, 200 engineers, 80 product managers, 50 of everyone else. So that's 480 people in addition to your customer support and your content reviews. That might be even close to 1,000 employees at this point. Okay, so with this, we can calculate up above the total personnel expenses in the operating expenses. So how many rows do we have here? Because we can just take this and just copy it. So copy this in. Here we go. And now we need to put in salaries. And so let's say that this team is fully based in the US. So I'm just going to kind of make up some salaries that, would be sort of reasonable assumptions. Let's say marketing people make 100K, creative 60K, technology, 120, product managers this, and executives and everyone else 125. So what we're going to do here, same as last time, we're going to take this, we're going to lock the column. So I just tapped F4, you'll see the dollar sign should be in front of the A. Yeah, there you go. Divided by 12, and then multiply it by the number of people. There you go. So we have one employee who's making $100,000 a year, divided by 12 months, $8,333 a month. So we can do this with everyone here. And one trick is it's good to just put commas. At the top of each section of the P&L, it's good to put dollar signs, but then just sort of best practice financial formatting after you just put commas. So you just put the accounting format at the top and at the bottom of each section. So now sum all this up, multiply it by your 25%. There you go. And a bottom border, and at the bottom, sum it all up again, and there you have a dollar sign. So this we can just copy across, very easy. There are some really complicated ways to forecast payroll, and I just recommend you do it like this. I've seen payroll salary models that are bigger than this entire financial model, and I just really don't think that it makes your model that much better to have an insane payroll model. I don't think it makes it more accurate either. Okay, so what else? We're going to have one final section, which is going to be other OPEX, and then we'll be able to calculate basically the profit from our company. So let's see here. So we have our advertising spend, and we can, again, pull that in from our user acquisition model. Remember, we had to start the whole model with ad spend, and you usually start most startup financial models with ad spend. So we have that $5,000 a month, and we'll link all that in, and let's just do that really quick. Okay, and then let's see. Okay, so I've got it in the wrong month. Remember, we start spending in January 2023. Okay, so link that in here. Okay, not sure why that didn't work. link in January 2023. Okay, there we go. And so, okay, now we have numbers through the last month, 2.6 million. Okay, that was the right number. Okay, so what else would we have? We would have other marketing. So advertising is not your only marketing expense. A lot of times you have to hire like tons and tons of consultants, experts who do really specific things that no one on your team knows how to do. So let's just say that other marketing is, I don't know, like $5,000 a month. And this could be so many people. This could be consultants for media buying, for PR, for all kinds of different stuff. So other marketing here, and maybe even just software subscriptions, Then let's say just technology in general. Usually you've got to invest a lot of money in technology, all kinds of different stuff, hardware, software, a million different things. And let's just put in like 20 grand a month every month for that. And again, this is probably not, completely comprehensive, but in your sort of other OpEx or miscellaneous sections, it's good to just put in a lot of stuff knowing that, there's going to be all kinds of stuff that comes up that you can't foresee today, but at least you have some dollars in your model to cover anything like that. So let's say miscellaneous fixed expense is another 20 grand. So that could cover all kinds of other stuff, travel, who knows, whatever else. And then a variable expense percent of revenue. So variable expense percent of revenue. So you can also put in a percent of revenue. Some people just put in miscellaneous fixed, and they put in like a fixed number. But you can also put in like a percent of revenue, which is always a good idea. So, our revenue doesn't start till January, but let's say we put in 5% of revenue of just like random costs. And it's going to be 5% for the first year. And then, in January 2024, it's going to go down to 3%. So we're just going to model that into the operating expenses, very simple. And so we'll do that right now. So let's go up to the OpEx. So how many sections do we have in there? Like 5? 1, 2, 3, 4, 5. Okay. So now we can just take this, Control C, Control V. So let's see. So advertising spend, we can just link that straight in. Of course, in the beginning, that's going to be 0. But we can just link everything in here. So we linked everything in, and then the one that we need to calculate is variable expense percent of revenue. So we're just going to go up to revenue, and we're going to multiply it by that percent. So here it's 0. And then bottom border, sum everything up, add it together, that's 40,000. And then by the tail end of this, it's going to be 3.23 million. And just really quick, by the way, if you're finding this content valuable, please like this video and subscribe to my channel right now so you don't miss any of my new videos. Okay, so now let's move on to operating profit as well as our VC fundraising rounds. So put in a few lines here, and we're going to have operating profit. And so this, I like to do a fancy, let's see, double bottom border, top and double bottom border. Okay, but before we calculate operating profit, let's just create a total OpEx line. So just total OpEx, so we can just add it all together. 372 plus 40,000. So there we go. So for operating profit, it's going to be gross margin minus total OpEx. So these two things we can calculate together, and then also let's just write the formula here for EBIT percent. EBIT and operating profit. EBIT is earnings before interest and taxes. Operating profit is the same. They're synonyms. So EBIT percent, I'm going to use that if error formula. If error divide your profit by your revenue. But if it's an error, show two quotation marks, which is 0. Shows nothing. Okay, so now I can take all this, copy C, shift right arrow, and where's the end here? Copy V. Okay, so why is that not working? Looks like I didn't copy it. Okay. So what are we about to see here? So let's just zoom out for a second. Okay, so this should be percentages. So if we zoom out just a little bit, I just want to look at, okay, where are we with our revenue? So if you look, our total revenue by the end of this is 19 million a month. But just 1 year before that, in December, it's only, 412,000 a month. So ramping up really, really fast as we increase our CPMs, as we increase our ad load, as we are starting to get the network effects from a lot of organic downloads. And so you'll see that the gross margin in the beginning is negative, and then it becomes positive, and then it stabilizes around 40%. And that our operating profit, is very, very negative. We're losing lots and lots of money each month, but we know that as we scale up our revenue, we will become profitable. So here it looks like by the end of this, we went from, very large burn rates to almost break even. So only negative 5% operating profit. So that means that probably within, 6 months or less, this business could break even if it wanted to. Or they could try to grow even faster and keep raising money, which would probably be the smarter decision. So now the final piece is let's look at any new capital that the business needs to keep growing through all these different phases in its life cycle, as well as the cash balance / runway. And you'll notice that I didn't create a balance sheet with this model. And the reason is because this business has basically no assets and it has no deferred revenue. It doesn't have complicated cash dynamics. You can basically just make the income statement cash basis, and that's the easiest way to do it. So, sometimes people would be capitalizing all their engineering costs to like an asset on the balance sheet and then depreciating it. But in this situation, I think it's easier to just expense everything. And it's totally fine. And because the balance sheet won't really give you more insights into how this business is working. So with certain startups, I don't think building a balance sheet is important, at least not for a while. Okay, so cash balance runway. So let's say to start this off, new capital, and I'm going to put this in blue, assumption's always in blue, I'm going to say $15 million. So what is that based on? Well, let's just say the backstory is that the team that we have that founded this company, really experienced team who have built other social network companies, who have a lot of connections, who have the idea, and a bunch of venture capitalists come in to back them and say, we really want to be invested with this team. So they're able to raise 15 million just on the idea. Then what you do is you take that initial balance, so you have 15 million in the bank, and you add the operating profit to. So this is your burn. This is how much cash you lose each month. So by the end of month 1, you start at 15 million, but then you have a little less. And by the end of month 2, you have your 14.5 million, you burn another 444, but then just add the new capital line to it so that anytime you put something here in the new capital line, it gets added into your cash. So let's say for the first 12 months, let's see if we have enough money for 12 months. So, okay, so for 12 months, let's zoom out a little. So for 12 months, we're burning through this cash. It gets down to about 7 million, but then we're ready to go live. And let's say we go out and we say, okay, we need to raise another fundraising round. We're down to 7 million, but we want to, push really hard on marketing now. We need a bunch of cash because we're going to run out of cash soon. And our same investors come back in and they back us with, 20 million more dollars. They say, wow, this is a great product. This is a great team. We want to be invested. So then now we have 25.8 $8 million. And so let's see how long that can last us based on our sort of increased burn rates. So let's take this out to December 2023. And so how much money do we have? Whoops, it's got to be backwards. Oh, yeah, got to delete the 20. So how much money do we have now? So it's going down. We're burning obviously $1.5 million a month. But remember, we are acquiring our first users now. We haven't monetized them yet, but we're building. So we get down, but I mean by December 2023, we're down to 9.5 million. So we go out and we say, okay, we need to do another big round. Now we've got, we're starting to monetize this month. We've got 106,000 users, but our growth is really parabolic. So we're going to go out and we're going to raise 40 million. And of course, the terms of each of these deals is you'd have to agree on a valuation and all this different stuff. But we're just trying to figure out what are our cash needs. So with this 40 million, let's see if we can get another 12 months, because now we're really ramping it up. We're burning a ton of cash now because we're growing so fast. We're burning 3 million a month, and so this 40 million gets us kind of another year, but it looks like we're running out of cash again. So let's say in January we raise. Now our revenue is, let's see what it is, 1.5 million a month, but growing, from 200,000, 3, 4, 1.5, and so the revenue is growing really fast. And let's say we're going to raise like a $75 million round, so we're getting a really high valuation now. And we say, okay, let's go for it, and let's see if that at least gets us to the end of 2025. Again, delete this. So by the end of 2025, our burn rate starts to actually decrease, and it looks like we're getting closer to break even. We got $50 million in the bank. So if we want to go more aggressively on the paid marketing, or we want to hire a much bigger team, or something like that, or we want to acquire another company, we've got a lot of cash in the bank. We're prepared. And just as an FYI, I mean, a business doing a social network or a social media platform doing, $18, $19 million a month in revenue at a $226 million run rate and growing this fast, this company would be worth many, many billions. I mean, 2, 3, 4, 5, 10, maybe even 10 billion. I mean, it's hard to say. It would depend a lot on the investors, but this is a multi-billion dollar company. And so, yeah, this is kind of what the dynamics would look like in three years of users and 1 year of sort of pre-user building a platform. And so I hope this video was really helpful and you learned a crazy amount. Okay, so now I hope you have a really good understanding of how social media and social networking companies monetize their users and scale. By the way, in the description below, you can download this Excel file completely for free if you want to use it for yourself. I've also linked down below to some of my other financial modeling videos, other really important startup financial model business models like the marketplace financial model, like the SaaS financial model, subscription-based e-commerce financial model. Check those out. And if you found this content valuable, please subscribe and click the little bell icon, like this video, leave me a comment below, and also check out my online courses if you need to improve your Excel and finance skills. That's all for today. Thanks for watching, and I will see you in the next video.